Fun fact about me. When I was a kid, I wanted to buy my first computer, and I was told save up for it. And I spent 2 years saving pennies to buy my first computer, a Commodore VIC-20, for $110. And after 2 years of saving, I went to the bank. I got penny rolls, and I spent like 2 weeks, hours a day for 2 weeks, rolling pennies. I had pink eye for like a month.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 86 of Drunk Real Estate. I'm Kyle Wilson, Ashley Wilson's husband. I'm trying. Jay's back. I was trying to get it in before Jay's ready to go. How's it going, Jay?
I was sorry. I was in the process of finishing a sleeve of Thin Mints when you abruptly started the show.
Where'd you get those from?
I got those from these adorable little girls that live in Philadelphia. My partner Ashley's daughters, amazing girls. Anybody? Are you still selling those?
1 week left, I think.
Okay, week left. So
Hey.
That's my plug this week. My plug this week is anybody that wants Girl Scout cookies, contact me. I might even send you a DRE mug if you buy some Girl Scout cookies from Kyle's Kids.
Oh boy. And I will bet you there is no chance you will order more boxes than Jay did, because I think it's actually impossible. He might have hit max.
I think that was my wife, so thank her.
What are you drinking tonight, Jay?
I just grabbed a random bottle. It looks like I got a Spanish Syrah called Calare Tinto. No idea what it means, but somebody gave it to me, so whoever it was, thank you.
Well, let us know how it goes. Drink the whole thing and see how you feel. Mauricio, what's up, buddy?
What's going on? I'm so freaking tired. I'm like on no sleep. Got home last night, midnight, went to bed close to 1, woke up at 4, did a podcast. But I'm here for you guys. I'm dedicated. I'm drinking. So if I fall asleep, producer Alex, if you could please call me or something and wake me up. I've been on, this is going to be a weird drinking one. You ready? I've been on this need and desire to want to get some of the Bailey's original drink. So I have a Bailey's Irish Cream that is absolutely delish before we commence our fitness challenge.
Just straight on the rocks. I thought you were going to say you put it in a coffee to keep you awake.
No, straight up. It is with ice. I don't like to drink it warm, but straight up ice. It's delish. It just calories galore, but we're starting our fitness challenge here pretty soon, and I got to get it all in.
Can't say I've ever done that. Even a White Russian. It's always been weird to me, like on ice and like it's
great. You know what's really weird is I had a protein drink in Miami that somebody gave to me, and it tasted just like Bailey's, just obviously non-alcoholic. It was a protein chocolate drink, and it tasted just like Irish cream whiskey.
Oh, you're already getting the supplements, getting all ready for our weight loss challenge. Yeah?
That's right, baby. You're going to notice. We should have not said anything, and you're just going to notice the amount of pounds melting, releasing from Mauricio.
We'll see. AJ, what's up, buddy? How's it going?
Going pretty good.
Got to do up a couple buttons if you want to look real Mormon up for us.
Oh. There we go. Tighten that puppy up.
How you doing, man?
Doing good. Got my red Solo cup with my Diet Coke. Ready to go.
You don't have any Thin Mints, do you?
I do.
Oh, you do? Okay.
I do. Yes.
Well, there you
I've
go.
been eating them for the last 2 days. I got home and there was boxes of them. And like you, I have absolutely devoured at least a handful of sleeves, not cookies, but sleeves. There's an empty box in my car. So while I'm driving from my house to work, I had one in my car so I could eat.
I got a DEXA scan coming up on Monday, so I got to get rid of all the Girl Scout cookies in my house by next Monday in order for me to be able to perform after that. I'm coming off a cold here, so I need to get myself a Monster. So I got a Monster, but I was like, what's something good, like something that no carbs, no sugar that I could mix into it. So I went into my fridge and I found this rum that's it's real clean American rum. It's called Clear Rum. So I'm just gonna put it in a little glass here, ready to go, and I'm gonna pour my Monster in.
So that is officially called a Clear Monster.
Clear Monster. That's a good way to go. It's better than ginger piss.
Tasteless, colorless,
odorless, and will kill you in your sleep.
Love me some colorless. Okay, let's get this going because Jay is making the call. Recession is coming. Recession is coming. 1 if by jobs, 2 if by retail. He's predicting the recession is coming. What'd you say, in the next 6 weeks? He's looked at the data. He's saying we have 6 weeks to live it up. So Jay, explain to us why this time is different from every other time we've said the recession is coming.
But just to be clear, he has a specific date and time.
Really?
Date and time.
Nostradamus.
8:30 a.m. April 4th. And we'll get to what happens on 8:30 a.m. April 4th in just a bit. But this is the prediction I made. I actually made this prediction last Thursday night. So this is, people can say, yeah, the market's been going down the last few days. It's been a really ugly few days. But I actually made this prediction last week before the market started going down. I said it to Mauricio when we were together in Miami Thursday evening. I said, it's coming. April 4th is the day. And then the next morning, we had a big stock market drop, and it's been a bad couple of days since. So a couple of reasons I think this.
Wait, are you going to sing the early morning April 4th song that was in your head?
Oh my God, I've been singing U2 for you put that in my mind back on Thursday, and I've been singing that song for 5 days now.
So April 4th is the assassination date of Martin Luther King, a well-known U2 song, Pride. And I sang it to him for a little bit, and then he just couldn't get out of his head for the last
all weekend. I've been singing that song. Okay. Yeah, we've predicted a bunch of recessions, but we've kind of soft predicted. This time, it's not I think it's coming in the next 6 months or 12 months. I think we are literally on the cusp, and it's going to happen over the next few weeks. I could be out of my mind. I'm probably out of my mind. But here are some of the things that are leading me down this path. And a lot of it's just a gut feeling. And I'll be honest, I like the data. I don't normally trust my gut. But I've only had this gut feeling a couple times over the last 20 years. I was right the first time. I think I would have been right the second time, but COVID got in the way. But I just have this gut feeling that we're heading towards something bad in the next few weeks. And so first thing is consumer and business sentiment. It's a big driver of recessions simply because when people think things are going to be bad, they start acting in ways that lead to things being bad. So a lot of people say, well, we know there's a recession when we see bad jobs reports, or we see high inflation data, or we see low GDP, or whatever it is. But the reality is, if you go back and you actually look at the data prior to those bad reports, typically what you see bad consumer and business sentiment index releases, data releases. And so just over the last couple of weeks, this morning, Tuesday morning, we got a consumer sentiment release from the Conference Board, which is a big consumer sentiment index, down 7% in February, lowest it's been since 2021. So consumer sentiment is kind of in the toilet. University of Michigan does a consumer sentiment survey every month. They're down 10% month over month in January. So they're trending down. Small businesses, there's a small business optimism index from a company called NFID. They were down 2.5% in January with a lot of concerns over inflation and the future for small businesses. Gallup does an economic survey. Gallup, basically 59% of Gallup responders said they believe the economy is getting worse. So for me, the first big sign and what I would consider to be a big leading indicator is simply business and consumer sentiment. And the fact that has turned so abruptly and has started to drop so quickly over the last couple months is indication to me that we should at very least be keeping our eyes open. So that's the first thing.
Can I push back on this a little bit?
Of course.
Just because you mentioned the University of Michigan sentiment, and there's a couple different indexes, but if you look at these indexes, to say that it's a leading indicator is a bit of a a stretch. Like if you look back, that yes, you could pick and choose, okay, this recession maybe, but like if you look at previous recessions, the sentiment basically dropped right as the recession was happening. Like the drop before that is kind of just a normal drop that you see happen all the time. So like you can't really say that this is like a leading indicator looking back at the data from these indexes.
Well, I mean, if something were to happen shortly thereafter the drop, like I think is likely, not, I don't want to say likely, that I think is possible going to be happening over the next few weeks, then this would coincide with that. But again, it's
what I'm saying is that level of drop, like if I'm looking at this graph, I don't know if it's worth pulling up, but if I'm looking at this graph, like it happens regularly. Like that kind of drop happens.
It happened last year. I mean, last year we dropped, from the second quarter, I'm looking at the Michigan consumer sentiment, but we dropped all the way down from like March all the way to July last year. And then we bottomed there. And then we kind of just slowly been going higher and higher. And we kind of peaked in December and now we're going lower. And
100%. I often describe the economic and for those looking, this is the University of Michigan Consumer Sentiment. I don't know if that has the most recent, because the last one or two.
That's through January, it looks like, or maybe December.
Yeah, maybe December. So, but I mean, the way I kind of look at the economy, it's like a puzzle. And if you have one piece of a puzzle, you have no idea what the picture on that puzzle is. You have two pieces, you don't have much. You have three pieces, five pieces, you don't know. But by the time you start getting dozens or hundreds of pieces, a picture starts to form on that puzzle. And the economy is the exact same way. One piece of economic data, one piece of consumer sentiment data, whatever, doesn't really mean much. But when you start to put together multiple pieces of data and multiple surveys and indexes, what you find is a picture starts to emerge. And so, yeah, I'm not saying that this alone, the business and consumer sentiment index is dropping, is my rationale for believing what I believe, but it is one piece of that puzzle.
Almost over 85% of the false positives, the times that the Michigan Consumer Index got it wrong, was during a time of high inflation. 85% of all the times it got it wrong was during time when prices were high inflation.
Which right now wouldn't qualify though, right, AJ?
Nope, we have low inflation.
No.
We have like 2% or something like that. So prices are really low. When inflation, I mean price within a like 2-year period or something like that, price instability in the market.
Yeah, but can I just also push back a little bit about that? And we've talked about this idea of the statistics and how you look at the overall market and statistics. When you look at specific stuff, I think what's troubling for individuals, I mean, I know we always joke about the price of eggs, right? I mean, obviously eggs have gone through the roof. But when you see the inflation that's happening at the grocery store, right? That's really where it becomes painful for the middle class, lower middle class, gas prices, groceries. That's where it really hurts. And so, yeah, maybe overall inflation may be 3% because, car sales over here and this other stuff over there. But when you look at grocery prices, I think those are kind of over-indexed. And I think that's where people are starting to feel it.
Can I tell a quick funny story? So we got a comment on our YouTube a week or two ago.
The first time for everything, Jay. So if you want to tell a funny story, go ahead.
Was it worth it?
Yeah, it was. It was good.
A couple weeks ago on our YouTube channel, somebody wrote a comment like, that whole egg thing, we must have made an egg joke. It isn't funny anymore, blah, blah, blah. Like everybody knows eggs are high. It has nothing to do with this or that or whatever. And I had to point out to him, obviously not a long time listener, but we've been joking about the price of eggs since long before the price of eggs went through the roof. It's just a coincidence that that's the thing we've been joking about for
like
over
an
a year
ongoing joke forever. Like
so for anybody that wants to
but even that, like the cost doesn't matter. Like again, folks, all they know is that the money isn't stretching. The end of the month is coming a lot quicker for them than the money they have. And whether eggs are up because there's bird flu or because there's a supply chain disruption, whatever it is, doesn't matter. The bottom line is the grocery bills are
so if the cost is up, would you say that leads to less spending, Jay?
Yeah. And
wait, hold on, Jay, just real quick. I said 85%. It's 66%. Sorry, not 85.
66% correlation?
60%. Yeah, of the false positives were connected to high prices.
Got it. and doesn't surprise me. Like, again, you take any of the things I'm about to say independently, and you can make a million arguments. Even you put them all together, and the chances of me being right about there being a recession in the next 6 weeks statistically are very low. So I'm certainly
just
not
as
saying
probably as you being wrong, though. Let's just be honest. It's like you probably have just as much a chance of being wrong as you do right. So, like, I mean,
I'll take that.
I think you got a high chance.
I mean, if I can predict a recession 50-50, I'll take that. Okay. So, yeah, Kyle, you mentioned consumer spending. Consumer spending is a huge indication of what people are thinking. And again, I mentioned a few minutes ago that when people act a certain way, it causes the economy to react a certain way. And if people think that they can't afford to go out and spend, if they're concerned about losing their jobs or their wages getting cut or their hours getting cut, and they start spending less money because they're concerned about their situation. Well, that spending less money actually leads into negative effects on the economy, which again reinforces their spending less money, and the whole thing snowballs. It's just a feedback loop of I act in a more conservative manner, the economy reacts in a more conservative manner, which forces me to act again in a more conservative manner, and things just spiral downhill. And so what we saw in January was that retail spending dropped about 0.9%, which doesn't sound like a lot, 0.9%, but that's in a month. And so you annualize that, you multiply it by 12, and basically what we're seeing is basically a 10% drop if we had that every month. And I'm not saying we're going to get that every month, but if we had that same reading every month for a year, that's a 10% drop in retail spending in a year. Retail spending contributes between 60 and 70% of GDP. So we're talking about a half point of GDP basically going away if this were to be.
But isn't that in line with seasonality?
So there is a seasonality, a seasonal component, but the seasonal component is nowhere near 0.9%. Normally it's up about 0.1% in January and February. Likewise, we talk about inflation data and the fact that we saw inflation pop in January. There's some seasonality there as well. We typically see retailers raise their prices in January.
Inflation rise was still higher than normal.
Yeah. So again, even accounting for seasonality, we saw some stuff in January that's a little bit concerning. So yeah, so the second piece is just retail spending. We talked a little bit about it last week, but retail spending is another good leading indicator of what people are thinking and ultimately a driver of what's going to happen in the economy.
So how do you justify that? Because one of the things that I know the Fed's super concerned about is this idea of sort of inflation expectation, right? People are worried about inflation with everything that's going on. Most economists argue, hey, if there's an inflation expectation, then people are going to go out and buy a bunch of stuff before the prices go up. Like if I think the price of the cars are going to go up 10% next year and I'm in the market for a car, I better rush out and buy a car right now. So how do you
do the opposite? You say, I'm going to drive my car for a couple years longer, and I don't buy a new car, and so that hurts GDP even more.
But Jay, wasn't like holiday retail sales was all like above expectations, wasn't it? So like we're talking about like 1 month, right?
Absolutely. Again, it's 1 month and it's one piece of the puzzle. And I'm going as much on gut here as I am going with the data, but it's another piece of the puzzle. Can I jump into a third piece of the puzzle?
Yeah, go for it. Let's
third piece of the puzzle is I like to look at what really smart and really well-informed people are thinking and doing. And so not just the three of you.
You talk to Mauricio?
I was going to say, you can call me anytime, Jay. You know you've got
I do. I talked to you all weekend, Mauricio, and I walked away with absolutely no insights. No new insights. But no, so here are two people I highly respect. One, Jamie Dimon is the CEO of JP Morgan, so one of the largest financial firms on the planet. He was in the running for Treasury Secretary, so he's a pretty smart guy when it comes to economics. He's got his pulse on the economy.
He's made quite a few bold predictions over the last year or so that has not come true.
He's made a lot of bold predictions that haven't come true. This time he kind of put his money where his mouth is. He just cashed in nearly $250 million, $234 million of his own stock. So you could say he's taking chips off the table. You can say that maybe his daughter's getting married and they're throwing a $200 million wedding. He just needed a little bit of extra cash.
Or he's pulling a Buffett.
And then secondarily, Warren Buffett cashed in about $130 billion in Berkshire Hathaway stock last year. Not him personally, but the company cashed in about $130 billion in stock, and the company is now sitting on about $330 billion in cash.
The highest ever.
The highest it's ever had. People have asked Buffett, what's going on? Why are you sitting on so much cash? He hasn't answered the question. But he has penned a couple articles recently about his concern about government spending. I don't imagine that's a new thing. I imagine it's an old concern, but it's probably top of mind these days. And so clearly Warren Buffett is a little bit concerned and doesn't want to be deploying capital into any assets or not too many assets, new assets right now. So between Jamie Dimon, Warren Buffett, and there have been a number of other big CEOs that have cashed in a bunch of stock recently, it just says to me that other people are a little bit more fearful than they have been in recent times.
So I obviously I'm not going to say anything about Buffett and his track record and everything, but this is the problem with predicting these recessions. And Buffett, you said he did it about a year ago. A year ago, the S&P 500 was about 5,000. What's the S&P 500 now?
It's about 5,000.
It's 6. It's gone up from 5,000 to 6,000 in the last year. So yes, he might be right in calling that a recession is coming, but like we've done it on this podcast. We've been calling a recession is coming for a year. And like the economy keeps surprising us and keeps going. So like at what point do we kind of just give in and say, okay, maybe it's just not looming around the corner like we think it is.
But too, though, a stock market correction doesn't mean a recession. And I think that's something that's really important. The stock market can absolutely retreat and we don't have a recession at all. And Warren Buffett has been building up a cash reserve for 3 years. So this isn't even new for him. It's been quite a bit a while. And two, I'd venture to say the stock market is probably more right now. It's at a level that is so crazy when you compare to not only GDP, but the growth of the GDP plus earnings. It's wildly out of whack. The multiples in the stocks right now, it's so beyond anything fundamentals. I mean, it's crazy, right?
But you could pick any measure you want and say over the last year, whatever he had decided to put his money in instead of holding cash probably has done pretty well. I guess that was my point, that like we're saying a recession is coming right now. People have been saying that for a year.
There's another, the third smart. I mean, I would put the two examples you gave, which you kind of alluded to, AJ, the Jamie Dimon and Warren Buffett, into the category of they just think the stock market is overvalued. I mean, Buffett is a value investor. He has cash and he's not going to go, chase high valuations. He's a value investor. He's looking for something that makes sense, and he's just not seeing anything in the market because everything's so inflated.
Well, and the PE ratios are like all-time high.
They're off the charts. They're ridiculous, right? What I've noticed, and I'm surprised that you didn't touch on this, unless you're going to do so shortly. The 10-year note has been not collapsing, but it's been coming down really hard. In fact, it briefly, and actually, as of right now, it's actually inverted to the Fed funds rate. So it actually dropped below. I mean, it peaked in January of this year. It was like about 4.8. It closed today at just below 4.3. And that's an indication that people are, the reason that the yield is going down is because the price of those treasuries are going up, which means the demand for those treasuries is going higher, which means the quote unquote smart money, theoretical smart money, is moving into the more safer treasury market, which usually indicates a level of fear. Like they don't feel comfortable putting their money in the stock market or on the real estate market or the bonds over there. They're going to go to where it's safe. That's usually an indication of sort of where they think the economy is going as well.
Or it could just mean they think its cuts are coming too. So like that's the thing with the 10-year treasury right now. It's so volatile with what the Fed is going to do. You can't just take that singular analysis of like, oh, flight from risk to safety or like all these different things. There's so many moving parts that every time the 10-year treasury moves, I got to go and I got to start researching it. Okay, why did it move this time?
Yeah, and I was trying to stick with my rationale for why I made this prediction last week. Since then, the 10-year has dropped about 25 bips. So we have seen a decent move in the 10-year in the last 3-4 days. And that I would definitely add that to my list if I were writing my list today. But I do want to answer a question that Kyle asked, which was, at what point do we kind of throw in the towel and just kind of accept that we don't know what we're talking about? And I'm going to say that day for me is April 4th. And I mentioned April 4th earlier in this segment. And so what is April 4th? Well, April 4th is not just the day Martin Luther King was killed, but it's also the first Friday in April. And the first Friday of each month is when a jobs report comes out for the previous month. And so I suspect, and I'm not unique in this view, I think a lot of people suspect this. It's started to be talked about a lot more over the last day or two, actually. And so who knows? Maybe a lot of people have been reading my Facebook post and writing articles.
Nobody is looking at your Facebook feed. Let's get over yourself, Jay.
I know it's just a coincidence that they're figuring this out a few days after me. But April 4th is the March jobs report. And I think it is probably safe to say that we are going to see a very, very large number of jobs lost over the next 4 to 6 weeks. Potentially the largest number of jobs that we've seen since the 2008 financial crisis, which would actually be more than what we saw during the 2020 little crisis. And so I suspect we're going to start to see the jobless data, which is basically the unemployment reports every Thursday that come out every Thursday, start to tick up over the next few weeks. But I suspect that the overall March unemployment report is going to be very, very ugly, many hundreds of thousands of layoffs. We're talking about potentially 100 or 200,000 federal layoffs. In general, it's between 2 and 3 to 1. The number of contractors.
They have a packages though, didn't they, Jay? So they wouldn't show up on the unemployment right away, right?
No, those are the people that took the buyout, but there are a whole lot more people. All the probationary employees, all the employees apparently that are not replying to this email that was sent yesterday saying, tell me what 5 things you accomplished last week, and a whole lot of other employees. I think there were 1,100 IRS employees, or 6,000, I think, IRS employees that were fired last week. So a very large number of employees that didn't take the buyout, but have just been fired, flat out fired. And then again, it's going to ripple down. For every federal employee, there's between 2 and 3 federal contractors out there. Many of them are going to suffer because, or lose their jobs, or get laid off because when we start to see federal grants going away, when we start to see federal contracts going away, when we start to see budgets cut, that trickles down to federal contractors very quickly. At the same time, there are a lot of private businesses out there that are starting to see that like something's happening. And so they're starting to shore up their balance sheet and their P&L, and they're laying off employees. We just saw that that Starbucks is laying off 1,000 people. And I mean, I'm not saying that's related to this, and I'm not saying that 1,000 people means absolutely anything in the scheme of things. But we're seeing a lot of layoffs. And we've seen a lot of layoffs in the tech sector for the last year or two, but Meta just laid off, I think, 6,000 people.
And employment's gone down. So I think the problem is we actually need layoffs. Like literally, we're at an unprecedented level. We have an employment crisis in the United States. And it's not because we don't have jobs. We have 8 million job openings. We're at 4% unemployment rate. And to get it to 5%, we would need a net negative of 1.8 million people. And right now, we need 8 million jobs and job openings. And this is something that I was shocked by last year, because when all the tech layoffs were going on, and we started to see huge corporate restructurings due to AI, and you're talking about like the numbers coming out were staggering, tens of thousands by like each one, right? And I thought for sure unemployment's going to rise. Not only did it not, it kept going down. And in January, it went down again. And I think we're at a point where unemployment, we should see it go up, but out of a pure realistic notion that we're at a point where there's just not enough.
Well, AJ, I want to get your opinion of this, where like, is our unemployment number different than it was 10, 20, 30 years ago, just because of how our economy works right now? I read an article where a guy was trying to,
I'd say a little further than 20 years ago, but yes.
But what was trying to convince me that the actual unemployment rate is 23%. And this is how he got there. He got here by saying basically, if the unemployment rate factors people who have part-time gig work, all of these things, they factors them all as employed. And if you take out all of the people who are only working a couple hours a week and take out the people who aren't making enough to be to hit the poverty level, so it has to be they're making less than the poverty level. If you take out all of those workers who are all just doing part-time gig work, doing all that stuff, that the unemployment rate's actually 23%. And that just made me think that, of course, there's always been part-time work, but in the way our gig economy is set up, it's never, I think, been so prevalent as it is now. And so should we be thinking about what baseline unemployment is differently, just because it's so much easier for someone to say they're employed, right? Like before, if you were unemployed and you want part-time work, you had to actually go somewhere and apply for a job. Now
I'm
you
going to
could
throw a
just
wrench in that, because if
go on your app.
you acted that way, then 40 years ago, unemployment would have been like 30+%, because all of the basically any two old house members, it was a fraction of households had two working.
I mean, I agree. It's not
And so-
23%.
But unemployment is only
is-
people who are looking for a job. It's not people who are unemployed. You have to be unemployed and looking for work.
Yeah.
Yeah, but Kyle, that's
so-
interesting, because I pulled up, Shadow Stats is a well-known, John Williams calculates the unemployment rate as if you were using the same metrics as the unemployment was measured back in the 1980s when they make the change. And I just looked at it, he's got it at 25%
5%.
unemployment if you were to use the same metrics as you did back in the 1980s, which again, I don't know how flawed
Well,
it is.
here's the crazy thing. I just spent the last 5 minutes on my calculator just doing some calculations. 25% apparently is 1 in 4. And if I look around at these 4, one of the 4 of us, Mauricio, is unemployed and making money at less than the poverty level. So
It's exactly
business.
correct.
sold
But
his
he's looking
business a
for
few
work,
weeks.
though.
Sold his business a few weeks ago and is now gainfully unemployed and making no money. So yeah, you are 1 out of 4.
100%. How much do you think the chilling effect of the Doge, not to get the Doge political side, but the Department of Defense, for example, is under extreme pressure because they can't pass an audit, they can't figure out where money's going. I wonder how much of the chilling effect that's going to apply when they're going to do some governmental contractors and it's like, hey, we got to tighten up a little bit. We can't just like throw money around like nothing. There's a lot of pressure on us to justify all of our dollars. How much of that is going to trickle into the sort of the federal contractor or defense contractor employment?
Yeah, I suspect a lot.
But are they just going to explain it away, though, I guess? Because like things like this happen, like whenever we have like a major strike or the LA wildfires or all these things, we do see the blips that month in the jobs report. So to me, maybe this April 4th, like, yes, there might be a blip, but aren't they just going to say, hey, that's because, all of these agencies got doged?
Yeah, and it's possible. But my hypothesis is April 4th is going to be such a bad report that it is going to be headline worthy, and it's going to impact the psyche of Americans to the extent that if we're not like things already aren't getting, even if things aren't getting worse over the next 6 weeks, is going to cause a big economic ripple.
But if we have an average unemployment's 5.5%, 6%, that's a huge amount of people that can get laid off for us just to get back to normal.
Oh, absolutely. And again, I think I said this earlier that a lot of this is perception as much as it is reality. And I think that unemployment, we've gotten so accustomed to numbers in the 3.5% to 4% range since Trump's first term, going back to 16, 17. I mean, with the exception of that blip during COVID, I mean, we've had unemployment at below 4% for basically the last 8 years. And so it's kind of, that's become the new normal, even though historically we don't have numbers that low. And again, you can argue that those aren't real numbers, whatever, but those are the numbers. And so I think we've gotten accustomed to that. And so if we see an unemployment read at 5%, 4.8%, 4.9%, I think the key is that it's going to be a big jump. It's going to be from 4% to 4.8%.
It's going to surprise and shock people. And it's going to scare them.
Exactly. And so
based on that shock, but based on the shock and awe, I told this to Jay when I saw him in Miami last weekend, that just to kind of push back and just kind of raid on his parade, I pointed out that the ADP, if this is true, the ADP report comes out on Wednesday the 2nd. And that always gives you kind of a preview of the bad news that'll happen on Friday when the
And a lot
payroll
of people
figures
pay
are.
more attention to that than the actual BS.
Yeah, so I'm going to say if there's a recession, and Jay's correct, I'm going to call April 2nd as the day, not April 4th, because that's when the ADP report comes out.
Well, this is why my Facebook post said that like the intermediate 6 weeks are going to be interesting, because I think we're going to start to see this on each Thursday unemployment or job unemployment claims, which is Thursday, and on new unemployment claims and ongoing claims every Thursday morning. So I think we're going to start to see this in the Thursday reports over the next couple of weeks. So I think that we will get a preview, and that might actually soften the blow a little bit. Here's the other thing, and this is the big thing I'm concerned about. And to AJ's point, yeah, we may not see 5 or 6% unemployment. It may only go to 4.4 or 4.6 or 4.8. But here's the question you have to ask yourself: are those jobs likely to come back anytime soon? And we're going to have, I assume we'll have a whole other discussion about this at some point about AI replacing jobs. But the reality is there are a lot of jobs that are going to go away today. And it doesn't matter who's in office. It doesn't matter if it's Trump or Kamala or Biden or whatever. It's not a political thing. The reality is if a job goes away today, there's less chance of that job ever coming back simply because of AI, simply because of automation. Now, maybe we have some opportunity. Maybe there's opportunity if we do bring manufacturing back to the U.S. That's going to create a ton of jobs. Deregulation is going to create a ton of jobs. So there is opportunity there.
What about the JOLTS report, Jay? There's 8 million jobs available out there.
I think it's worse. I take the other side of that coin. In the short term, maybe, but in the long term, we have a huge crisis for jobs because by 2030, the amount of baby boomers retiring a day is like 100,000+, and our replacement rate is nowhere near. We are projected 50 million jobs shortage right now. When you look at this curve, it's astronomical. In fact, I think AI is the only thing that will save our economy because we do not have generations to come back. Us millennials move first year millennial, but moving forward, right? As we come up and we become the new baby boomers in the age of baby boomers, there's no one to replace it. There's no new people coming in. And I think that this is literally in the next 10 years, this is like a crisis. It's one of the reasons why we have such low unemployment is because the only thing that really saved us was baby boomers literally staving off retirement. They're like, we're going to extend it. And that's saved us for a while.
Their millennial kids are all living at home.
And two, this actually, this really ticked off millennials early on because after the great financial crisis, they didn't retire, they stayed in, but those job openings didn't ever come. So then all of a sudden you had a generation that's like, we want you to leave so we could take it. But that's not happening.
We can take your houses too. Go move into a home.
Yeah.
Three of those houses for us to buy.
But it's not happening. So I think AI will be the only thing I think that can save us because that's a massive problem.
I like that.
Kyle, you talked about the JOLT survey.
I'm sorry, I joked about the JOLT survey because I think it's one of the biggest BS surveys ever. But yes, if you have,
but it has some good data, and I think the whole point of the JOLT survey it's what job openings and labor turnover or something.
Basically, it is to put a job opening up online these days. Like it wasn't like before where you had to take out an ad in the classifieds or in the job section or anything. Now, like for free, I could just throw a job opening up, and if you fill it, are you really going through and taking down every job posting you have, or maybe you're opportunistic? Somebody might come along that'll be a good fit or something. I just feel like there's so many openings that are out there that are just not real job openings.
I agree, but I think that is why, and I think we're heading in the same direction here. That's why I think the JOLTS was actually interesting over the last couple of months. We've seen the number of job openings over the last year, listed job openings, drop from about 8.9 million to 7.6 million. So 1.3 million job openings. So what's that? 1 out of 6 has gone away in the last year, which is a significant number. We're seeing a lot of companies that were doing exactly what you said. They were throwing up job openings in hope of finding the right person. They're basically, I'm not going to say they've stopped doing that, but there's a whole lot less of that now than there was a year ago. Which is
1 year membership trial expired and they didn't renew.
Yeah, exactly. So anyway, that's my thesis. I know it's a very bold claim to say I think we're going to see a recession on a particular day or over the course of 6
Well,
weeks.
I do have one question then for you, Jay. So we will have before then another CPI print, and we have PCE this Friday. How do you think? Think inflation readings are going to play into that? Because do you think that some of this, like you touched on sentiment, obviously spending goes along with sentiment, and it's kind of a self-fulfilling prophecy where people think we're going into a recession, so they spend less and put us into a recession. If the CPI comes back and is a little bit more under control, and the media starts reporting that okay, everything's all's clear, do you think that could put a little hitch in this plan?
The hitch in whose plan?
In your plan that we're spiraling to recession.
Well, no, I
April
mean,
4th.
if you think we're heading towards a recession, the natural reaction to that is people aren't going to spend as much. People are going to cut back, and inflation's going to drop. And so, if we start to see inflation numbers come down, or if we see inflation numbers lower than we anticipate, I think that's a good indication that things are actually probably worse than they should be, because by all intents and purposes, there's no reason we should be seeing low inflation numbers right now. Again, I don't want to get political on
without
this.
job loss.
Well, yeah, and that's my point. If we see low inflation numbers, it's simply because of those job losses. Because every other economic factor out there is basically inflationary right now. Not every. I mean, we have deregulation and we have hopefully cutting budgets and stuff, which is deflation or disinflationary. But most of the stuff going on in the political and economic world right now is inflationary. And so, if we don't get a high inflation read in March for February numbers, that's going to be one indication, another indication that people have slowed down their spending, and we're seeing a turn.
Hey, Kyle, but just to piggyback on your thing about maybe he's going to change his mind, here's my prediction. Jay's talking a lot about his gut feeling, and I think it has a little bit to do with the fact that his gut has gotten a little bit bigger over the last few months or whatever. But I think over the next 6 weeks, his gut is going to get smaller and smaller and smaller. And that's going to change his tune a little bit as we get closer and closer to April 4th. It's going to be a smaller gut. He's going to have a smaller gut feeling. And I think he's going to change his tune over the next several weeks.
That's true. You can't trust a small gut.
It's true. But in all seriousness, I do want to poll the group here and see who agrees with Jay. So Mauricio, are you agreeing with Jay that we're going to see this?
I've obviously been on the camp that we are going to see a recession. I don't see anything new in the data that makes a compelling argument specifically that that's something different, some swan event or something that's happened. And maybe it is about to happen, but I haven't seen it yet. So I'd like to see some more data points before I jump on the bandwagon.
AJ, you with him?
So here's my problem, and I don't like trying to call recessions or not because I don't know. But when looking at the data, I think Jay could be right. So I think there's not all the things. I think employment will be better because of where we're at. But Jay could be right about every point and still not be a recession. And that's always the thing. That's always the thing that gets me is because I could be right, but that doesn't mean there's a recession. So
most of the reasons that we were calling for recessions before are still holding true right now. It's just it hasn't happened, right? The consumer debt's all time high. The PE ratios in the stock market are all time high. The jobs reports have been corrected 1.8 million last year. Like all these things are still holding true. We still haven't quote unquote called a recession. Technically, we could be in one right now. They just haven't called it. But
I think we will see one in the next few years. Simply, if we can actually, if you can get rid of. If Doge and Trump and all them, they can actually get rid of trillions of dollars and we have that will create a recession. And people get either mad or weird when I say this, but I'm I don't think that's a bad thing. If you really want prices to come down, that's how you get it. There's no magic wand to this stuff.
Well, and obviously the Fed's a wild card too, right? They already were talking about winding down QT.
They have a war chest to stop us from going into a recession right now.
And they were talking about winding down QT too, which obviously would help. And we're not going to get into that, but I agree. I don't disagree, Jay, with your stats. And I would say a year ago, if you laid these all out, I'd be like, yes, recession's happening. But I've just been fooled too many times over the last year and a half where I thought it was
I'm great with
coming and
that.
then it just
That gives me 3 I told you so's if I happen to be right.
didn't.
And if I'm
Fair enough.
wrong, it's another bad prediction from our group of 4.
And then the good thing is when you're right, you could just blast it everywhere. When you're wrong, you kind of just never talk about it again.
Exactly.
All right. Let's move this along and give Mauricio the stage here, because it seems like syndications are everywhere. But it wasn't until 2013, actually, that when the exemptions were made to the Regulation D that allowed people to raise money without having to register them as securities. The 2 most popular of these exemptions lately have been 506B and 506C. And while they're similar, there's a few distinct differences between them, and it can sometimes make difficult for us as real estate investors, since this is a real estate show, when we're choosing what to do with our syndication. So luckily, we have our own little syndication attorney here. He's looking to give advice. He's the best out there. So why don't you break this down for us, Mauricio? Give us the lowdown.
I want to make this more of a debate, right? So I'll give the context, but I'd like to. I know, Kyle, your better half is a staunch opponent of the 506B world and is a big believer in 506C. So, and I do think these exemptions that I'll go into in a second are principally responsible for this explosion of syndications that have happened over the last decade or so, and how, even the Uber drivers gotten into it and all that stuff, and potentially you could argue has caused a lot of these issues. But just to backtrack a little bit, just to get a bit higher level, when syndicators, which are basically just, people who pool capital, right? They go out there and they raise money and they pool capital into an entity to go buy, in our world, a bigger piece of property. That's what all of you guys here do. You raise money from investors and you go buy either multifamily or self-storage or whatever asset it is. Generally speaking, when you're out there raising money like that, you are in the business of selling securities, right? And when you are doing that, you have to either register your syndication with the SEC, the Securities and Exchange Commission, or you have to find an exemption to registration. That's the rule. Either register or find an exemption, or alternatively, it's illegal. Those are sort of your 3 options.
And registering is a bitch, right?
It's an IPO. Like you're going to go public. You're going to have to, you're spending probably 7 figures plus. It's going to take you a year or 2 to get registered. And as real estate investors, you just don't have that time. You don't have that kind of time. Like, you're in contract to buy a building or in a self-storage or whatever it is. You've got to close in, 60, 90, 120 days. You don't have time to go, you don't want to register your syndication with the government, ask for their permission, have the government do an audit and a deep dive into your stuff. You just want to go get it done. And that's what these exemptions are made for. It's for these sort of smaller companies that have sort of generally kind of a private offering, meaning you kind of know people in there. There is obviously the 506C that came out about a decade ago. But bottom line is you have to either register or you find an exemption. And as you mentioned, Kyle, there's a bunch of different exemptions out there, but the most popular ones out there are these Reg D exemptions, which are the 506B as in boy and the 506C as in Charlie. And these are very, very popular because, number one, they're safe harbors, meaning if you comply with all the requirements of them, you're kind of assured of compliance, which is what we want. And they preempt the state. So I don't imagine having to worry about, you're in Philadelphia, in Philadelphia, I got Florida, I got Idaho, I got California. I mean, imagine having to comply with all these state regulations. It's a nightmare. So using one of these federal exemptions kind of makes you not have to worry about the specific state statutes, which is very, very beneficial. But there's always this debate as to which one's better. Is it 506B? Is it 506C? And so I wanted to kind of go through them really quickly, high level. And then I really ideally would like to have a little bit of an argument. I don't know if you guys, Kyle, Jay, you obviously your partner. The reason you guys
we're a little bit skewed. We're obviously going to take the C side. So if you want to lay out the B side,
I can lay out the B side. I know all of you guys like to do 506C, and when I go through these things, you'll realize why. But even today, the vast majority, and I mean the vast 90% plus, the last thing I saw was like a 92-8 split, are still 506B offerings, even though the 506C is a relatively new offering from 2005.
Well, can I interrupt real quick? Is that number across all asset classes? Is that specifically real estate? I'm not saying that
number of deals.
It's a little bit it is a little bit misleading because it's across all assets and all capital raises. So it includes the Blackstones, the JP Morgans, the Merrill, like all of those guys. So if you think about it, all of the big boys and girls, like Blackstone. I always give the example of Blackstone. Blackstone, I think it goes up every year, but I used to say, hey, the largest real estate fund that I'm aware of is usually a Blackstone fund, and it used to be $25 billion funds that they put together. They've got one now that was supposed to be 50. It might be up to like $75 billion that they're raising for specifically for real estate. It's a Blackstone fund. They rely on 506B. But they use broker dealers, right? They're out there using broker dealers, so they can actually they can use the relationship that the broker dealers have with their investors and impute those into their stuff. And so it includes all those guys, right? So
well, and also I'm assuming it doesn't distinguish between deal size too, right? Because like if you're doing a tiny deal that you need, $100,000 raised, and you go out and you get 5 buddies and raise 20 grand, then you're going to do a B.
Yeah, but it feels like, just my impression from talking to people in the industry, it feels like in the multifamily world, it's 80%, 90% 506C, which is the exact opposite. And maybe that's not the case. Maybe it's just the people I hang around with.
I will tell you from our own, from Premier Law Group standpoint, having done, we do a couple hundred every year. About 2/3 of the raises we would handle, which are specifically real estate raises across pretty much all asset classes, but pretty medium size, like, $5, $10, $15 million raises. We're not talking $100 million or, $1 billion raises. It's about 2/3 to 1/3. So 2/3 still were 506Bs and about 1/3 are 506Cs. And the reason for that, the reason the 506B is so popular, right? Here's kind of one of the cons. Let me go through quickly the elements, and I'll tell you what the pros and cons are.
Well,
so with both,
before you jump into this, though, I want to talk. You mentioned something I think is really important. I don't think a lot of people understand how much has changed in the last 10 years. And I get every industry is different, but even if you look at storage, like when in 2007 or 5 through 7, the total filings were like 10 for these. In 2024, it was over 200. So in, a very short period of time, and these are large filings. These are not small ones. These are very, very large ones. But that degree of a change in such a short period of time is wild to think about. The amount of, I think all of those even recorded were like $1 billion. Like that was like their target raise. So that doesn't include all the underneath and everything else, which is just exploded in popularity. An industry within itself that didn't even exist.
Yeah, and we've definitely seen, it's no coincidence that, the changes in the rules which happened in 2005. 2015, sorry. So 2015. Well, the Jobs Act came out in 2012. It took a couple years to get done. So it was 2014 that the 506C came out. And it's if you look at it, a graph, the amount of people doing syndications have gone off the charts, and it's kind of spilled over. And this is kind of the issue that I think we're going to address today is, even though the 506C, which allows you to sort of advertise, and we'll talk about that in a second, it's kind of spilled over into the other one. Then everybody thinks like, well, hey, everybody's advertising, maybe I can advertise too. And so a lot of people doing the ones that you're not supposed to advertise, they're advertising anyway. And that's, I think, part of the issues we have, because a lot of people just don't quite understand the differences between two exemptions. The two exemptions are actually very, very, very similar. They both have almost identical rules in terms of the size of the raise. Both of them, you can raise unlimited amounts of money, which is why the Blackstones and the JP Morgans and all these guys can raise $25, $50 billion and still use these private exemptions. So both of them, you can raise unlimited amounts of money. Where the differences come into play is your ability to take on what we call non-accredited investors, right? So an accredited investor, somebody who high net worth individual, $1 million in net worth, excluding primary residence, or high income, usually 200 grand a year for the last 2 years, with an expectation of earning that this year. And if you're married, 300K. So high net worth, high income people are accredited investors. With 506B, I believe in our industry, the reason it's so popular is because you can take up to 35 non-accredited investors, right? Which is cool, because if you're just starting out, Aunt Karen, Uncle Bob, your brother, your mom, like somebody's going to be non-accredited, your buddy from high school. So being able to bring those people that are in your network is very, very attractive. So you can bring in some non-accrediteds under 506B, but you're not allowed to advertise or generally solicit. It's meant to be a private offering between people you know in your intimate group. It's not meant for you to go blast on social media and go on podcasts or talk about it. It's really meant for your inner circle, friends, family, people you know, coworkers. That's what really 506B was meant to do. But as you mentioned, Kyle, in 2013, 2012 is when it's passed, but 2013 when it got implemented, 506C came into the world. Before, by the way, if you guys probably don't remember this, but before 506C existed, it was just called Rule 506. That was it. It was called a 506 offering, right? Because there was only a 506B. So only a 506. So B and C only came into play once the C came in. And what C allowed people to do was it allowed them to go out into the world and advertise their deals, which makes very little sense because it's still technically a private offering. It's still a private raise, but it's got public characteristics. You can actually go out there and advertise and generally solicit and go on Facebook and go and pull out ads, and you can basically advertise, which you usually up until then could not do. So 506C allows you to advertise, but it does limit you to accredited investors only. Right. So unlike a 506B where you can take up to 35 non-accredited, 506C, you are limited to accredited investors only. And you have an additional burden of showing and verifying that they are accredited. You must take what's called reasonable steps to verify that they're accredited. So those are basically your two pivot points. They're identical exemptions, except one allows you to advertise, which is 506C, but limits you to accredited investors only. And one does not allow you to advertise, which is 506B, the original one, but it does at least take up to 35 non-accrediteds. And so there's this big debate over the years. And, I'll tell you what the pros are, obviously, of a 506B, which
Can I ask you a quick question? You just said that a 506B can take up to 35 non-accredited?
Yeah.
So what's the value or what's the benefit of BlackRock doing a $75 billion fund as a 506B? Because I can't imagine any significant amount of that 75 billion is coming from 35 non-accrediteds.
Yeah. So the benefit is that they don't have to verify. Well, first of all, they've been doing it this way for maybe even centuries, right? They're just used to doing this exemption, but they don't have a requirement to verify them. And that's usually the sticking point for 506C. These institutional investors, these high net worth individuals are not used to people digging around their balance sheets and their financials and looking at their tax returns. Like they don't really want to deal with that. And if there's no need for that, because again, these institutional guys always work with brokers, and brokers spend tons of time in the relationships with their investors, getting into relationship with those investors. And so when an investment comes, they put a lot of effort already into that relationship with the investors. And so that's how the broker dealers work.
And I guess if somebody's investing $1 million into a deal, you don't really need to check their accreditation.
Yeah, well, that is true. But and that's one thing. And then the level of disclosures is also different, right? So when you have non-accredited investors, your obligation to provide disclosure information goes off the charts. It's the same as if you were going public. Like it's very, very detailed. You basically have to treat non-accredited investors like they're idiots and they're morons and they can't take care of themselves. And so you've got to disclose absolutely everything. And if you miss even one little thing and, hey, the building was black when it really was gray, that potentially could get you into trouble. So with accredited, you don't need to do that. You get away with a lot more with accredited because the law assumes accredited investors, even though it's not true, that accredited investors are smart. They know what they're doing. They have the wherewithal to lose the money. They know what questions to ask. And so there's less concern about accredited investors. But clearly,
which is kind of funny because in our experience, it's the people who invest the least that ask the most and most pointed questions, right? The people who invest more, they're usually the ones that they don't pay attention as much and they don't show up to the investment meetings or anything like that. So
that would be a great pro. Actually, probably one of the reasons you probably like doing 506Cs is because you like to deal with investors who don't really care. They write you $100,000 check or $200,000 check. It's a small percentage of their net worth. If they lose it, who cares? They're not really worried. You ask for a cash call. Great. How much is it? Like they're not super concerned versus the non-accredited investor who gives you $50,000 and that's half of their net worth. And man, if I'm going to lose this, it ruins my entire life and my kids can't go to college anymore. They tend to be a little bit more involved in squeaky wheels. So I think that's actually an argument in favor of why you would want to take a
I
credit
mean, that
investment only.
is an argument, but I would say our preference of C boils down to a single thing. And correct me if I'm wrong, Jay. It's just the safety, like the chance of getting in trouble goes way down. Like we have friends, personal people we know who have gotten in trouble with the SEC because one of the people, not them, one of the people they partnered with on a deal that was a 506B solicited an investor that they weren't supposed to, said something wrong, did something the wrong way, and just because they were associated with that on the same in the same GP, that they've gotten in trouble and they've had to pay fines, they've had to, basically be put in the penalty box, all of these different things for something that they didn't even really do. They just partnered with the wrong person. And as you said, with all these disclosures, like you don't disclose the right thing, you post the wrong thing online. And it correct me if I'm wrong, Mauricio. The problem here is because when we get it into it, like when we have a partnership with another group and they have a different SEC attorney. The problem is that a lot of these edge cases and things, they're not really that clear in the rules. It's almost like people interpreting the Bible. Like everyone has their own interpretation. And so when like we went to partner, this just happened a couple of weeks ago. We went to partner with this one other group, and they had their own SEC attorney, and they had sent us an email, and we looked at that email, and they had said it was a 506B, and we looked at it and we sent it to you guys at Premier Law, well, your ex company, Premier Law, and we were like, "Hey, is this cool for a 506B?" And like the recommendation was like, no, like they should not be doing that. But then their SEC attorney cleared it. So it's just one of those things where it's like it's too much of a gray area, and that in the way the SEC is probably going to work is if one of those people in one of those groups does something bad and gets looked at, then they're going to look at all their deals, right? And then if we're partnered on one of those deals, then we could get in trouble. So we'd rather just not take that risk, go 506C. It kind of sucks because it limits some of the people that might not be able to invest in your deal. But at the end of the day, we're a better chance of being around here in 2 decades than the alternative.
Yeah, I would agree 100%. That's probably the number one reason I would say 506C is attractive is that we do have a lot of gray area in the compliance. We just don't have any guidance. It's open for interpretation. And so with a 506C, you just eliminate all that gray area. Like, hey, can I email this person? Do I have do I have an existing relationship with this person? It's very vague. If it's a 506C, you don't have to worry about that. You can literally meet somebody on the street tonight and then tomorrow morning send them your pitch deck. No worries. But with a 506B, and I think, we were at an event, actually a Premier Law Group event a couple of years ago. Actually, Jay, you were there and Ashley was there, and you guys made a very compelling argument which I think is actually true, which is if you look at most 506B deals, people are blasting out those pitch decks and those offerings to like thousands and thousands and thousands of people on their email list. And I would venture to say they would have a hard time showing me in a database and documentation that they have a pre-existing substantive relationship, which is kind of a prerequisite with all those people. Because they're not just blasting it to 30 or 40 or 50 people that they've had phone calls and gotten to know pretty well. And hey, these are or prior investors. It's literally people they just meet at a conference the week before. And that's happened to me a bazillion times where I'll go to a conference, right? I'm handing out business cards. People are handing me their business cards. And these sponsors end up with my business card and they don't remember that I'm there to, obviously was there to go get work. And so I would end up on the opposite end of a pitch email a couple of weeks later, and I don't even know who these people are. So I certainly did not have a pre-existing substantive relationship with them, yet I'm getting that email that's, soliciting investments. And so I think that's where I wouldn't even argue the gray area. I think a lot of people are definitely generally soliciting their list. They don't necessarily have a pre-existing relationship with everybody on their list. And again, if I'm on a 506C, I don't have to worry about that. I just blast to whoever I want. I don't have to worry about whether I have a relationship. I don't have a relationship because you are allowed to advertise. I think that's probably the biggest argument in favor of doing a C is just eliminating the gray area, eliminating that email list. I mean, it's just thousands of people that you're emailing to.
And the major con that you brought up is getting better, right? The verification of accredited. Like because of technology, there are some pretty easy ways to do that where you kind of outsource it to a service online where there's a bunch of different ones. I don't want to plug the wrong one, but like if you just look up on Google, accredited verification process, there's a bunch of different websites that'll do it for you, and you could just outsource it to them, and they will go through the backlog of process and give you a letter from a lawyer, and that that kind of just absolves you from the
Yeah, but the con there isn't necessarily the mechanics of getting the verification of the investor. It's that in high net worth individuals don't want to provide that information, right? So if they're looking at 10 deals to invest in, and let's say you have all else being equal, well, do I want to invest in a deal where I've got to provide my tax returns, my financials, and disclose my private financial information, or do I go with you guys where I don't need to give that information? So there's a lot of pushback. And that's I've got some really high profile clients that for decades have been doing 506Bs, accrediteds only. By the way, to your point, Jay, like, why would you do that, right? Like, the question is like, wait a minute, you've got a huge platform. You do only accredited investors anyway. Like, you don't take, because they don't want to deal with non-accredited, because the risk really isn't in B versus C. The risk is accredited, non-accredited. So they're already not taking accredited, non-accredited. They're doing 506Bs. Well, why? Well, because their investors are just used to, writing the check and not having to verify that they're accredited. Not to mention, there's a lot of people that are in that gray zone, even on the LP side, where like they tell you they're accredited, but when it comes to actually time to verify that, they may not really pass muster. So you may actually lose some of those people that you believe are accredited when it's time to justify it. You just can't do it.
So just for our listeners and just to verify from my own knowledge, because we don't do 506Bs, but if I were to take an accredited, if I were doing a 506B and I were to have an accredited investor who, let's say, did go through the accreditation process and got a letter from an attorney or CPA, would I still have to have a substantive relationship with that accredited investor? Okay, so
I'm sorry. So if you're doing a 506B, yes, so absolutely yes. In a 506B, whether they're accredited or not accredited, doesn't matter. You're going to have you cannot generally solicit or advertise an accredited investor. So generally, the way you show that is you have to have a pre-existing relationship with that accredited investor. Yes, 100%.
So here's what it boils down to for me. If I do 506B, all of the investors that I don't have a substantive relationship with, I cannot solicit. That's probably more than 50, 60, 70% of my database. So 506B, 70% of my database is excluded. 506C, the percentage of my database is excluded is those people who don't want to go through the process of getting accredited, which is not going to be 50, 60, 70%.
Which also, like, correct me if I'm wrong, just a letter from a CPA stating that their client is accredited, that suffices, right? Like, so these high net worth individuals that they don't want to be, going through all these things, they'll have a CPA that works for them.
A lot of CPAs won't provide that.
Yeah, there is an issue because, the reason why so you're right. One of the ways you can show that you're accredited is get your CPA who does your files your taxes, knows your financial situation, to write you a letter called a verification letter saying, hey, I represent Jay Scott. I'm a licensed CPA in Florida. I've taken reasonable steps to verify that Jay's accredited. And I'm telling you, based on what I'm seeing here, financials, he's accredited. Great. The reason that works is because you're offloading the compliance requirement to him or the CPA, him or her, and their license. And I've spoken to many CPAs, especially the larger groups that have, insurance counsel, have insurance policy. They actually don't want to provide that letter because of all the liability. Because if it turns out the CPA is wrong,
liability, like from you onto them.
Yeah, because what happens with verification thing is you're off, which is why I love it. I recommend every single client who does a 506C to offload and get a verification company. Because Kyle, to your point, there's all of these verification companies that will do it for like $50, $60, $70 of verification, and you offload that compliance risk onto that company. So it's amazing. But a CPA, usually what I've seen is if they're a solo practitioner, they need the business, they'll do it. But if it's a larger firm that you have and they have insurance and they have insurance counsel and they send it to insurance counsel before sending, they tend to want to change the verbiage of the letter to kind of eliminate that liability component to it, which makes the letter basically not usable. So anyway, so I think that's, so 506C to me, I'll be honest with you, I'm a little bit surprised because again, I'm old enough to have been on stages prior to this rule passing. And I remember when it was a proposed rule. I remember when it became a rule. I remember when it was in the, hey, it's going to happen in a couple months. We were all super, super excited thinking this was going to blow open and, everybody was going to be doing 506C. But because I think of this non-accredited component to it, still the vast majority of our clients at Premier Law Group anyway, when I was back there, they were still sticking around with 506B. Because to your point, Jay, in your example, push back a little bit on your example. You said, hey, if you have your list and, what percentage of people do you not have a pre-existing relationship? You say, well, 70% of my email list went away. Well, same thing with the 506B. Like if you have a list and I can only sell to accrediteds only, well, that might eliminate 80% of my list because 80% of my list is not accredited. So I'm only stuck with 2%, 20% of my list. So that's kind of the conundrum that people have to face. And the way it usually works, just maybe I'll wrap it up here, but the way it generally works is most people who start out doing syndications will start out doing 506Bs because they need to get their friends and family and their mom and their cousin and their uncle and aunt in the deal. And then after they've done 2, 3, or 4 deals, they tend to then say, okay, well, I've run out of my own money or my list is kind of expanded here. Let me then move on to a 506C. So I expand my ability. And then with the new rules, where I can actually do both, where I can start with a 506B and then transition to a 506C. That tends to be a nice transition period for these folks have done 4 or 5 syndications, have a bunch of non-accredited in their database. That becomes an option where they start doing a raise under a 506B and then at some point transition to a C under the same raise, and that solved a lot of the problems.
To me, if you're using the word raise, like you're raising money for a deal, then like just go with 506C if you can help it. Like if you're one of those, like as you said, when we're first starting out, if we have a deal, there's a few of us together, it's not really raising money, right? Like there was 4 or 5 of us that were like, hey, I got a deal, and we all pitch in money. Like even if even one of those people is a limited partner, they're not active in the deal, you have to do a syndication. And in that case, 506B makes sense, but you're not really raising money. It's just you're saying, hey, I got another deal, and the people are giving you money. If you're having to raise and get money from people who you weren't sure if they were going to give you money or not, to me, like 506C is just the safe way to go.
What is the cost differential and what is the administrative ongoing differential between the two? So you have a 506C. So if I'm going into it and I'm thinking about this, yes, there is of course, who I'm trying to attract, what that means. We're talking liability, everything else, but on an ongoing basis, like what is the cost? What does this look like? And how, is one more complicated?
The bump in the cost happens from the point where, if you're raising a really small amount of money and maybe there's a way to structure this where there's not a lot of investors and we maybe be able to structure this without making it a security, like maybe it's a joint venture, maybe we can actually legitimately structure it that way. The cost difference between that and then jumping into a syndication is huge. But once you're in that syndication mode and you're going to spend money on an SEC attorney, the cost differential between a 506B or a 506C is negligible. The only real additional expense here would be the verification companies that you're using to verify the 506C. And in some circumstances, not highly recommended, but sometimes if it's a small amount of accredited investors, you can get away with not doing a full-blown PPM. That would make it a little bit cheaper. But most of our 506C deals, we do a full-blown PPM anyway, because that's something that not only protects the investors, but also protects the client. So the cost differentiation between a B and a C, at least in our world, wasn't very significant. It wasn't material enough, I think, to sway you one way or another on the cost.
Pay attention to the state fees, though. I just remember in certain situations where we were getting a new investor and they're from a certain state and they were the only one from that state, and we were like, you know what, keep your money. You're
yeah, good. we don't want it. Like we don't. Sorry.
Yeah, New York.
Every single, to your point before, Mauricio, every single state like has a different rule and has different costs. And there's some states that are much more expensive than others. And yeah, if you're getting 15 investors from that state, the cost is kind of spread out across them. But if you're getting one $50,000 investor and it's costing you thousands of dollars to file in that state, you could just be like, hey, well, we'll catch you on the next time, or go get some friends before.
Yeah. So to be clear, for clarification, we actually do not worry about state securities law. So I don't have to worry about Florida or these states and their securities law, but there is a notice filing requirement. So it's called a Form D because it's a Regulation D off exemption. So I have to file a Form D in every state I have investors with. And yes, they all require a fee, a licensing fee, a couple $100 usually. But some states like New York comes to mind, they're over $2,000 filing, while most of them are $200 or $300. So if you're taking on $25,000 investor in New York and they're charging you $2,500, that's like 10%. You may want to think through that.
All right. AJ, I assume you're doing C's. You're on the C train?
C train, baby.
Nice.
Yeah, once you guys have an audience, look, we've got Bigger Pockets OG. We got one of the top self-storage guys with a huge audience. Once you're in that world,
and we have Kyle.
Kyle's, Kyle just sits home all day watching. You play video games, right? That's what you do, Kyle?
Yeah, I'm a Pokemon guy.
Yeah. So, but if you have an audience, and one of my big clients, an influencer guy, he had a huge audience, huge YouTube channel, and he was still doing bees. And I'm like, dude, you've got a huge outlet. If you've got a huge podcast, a huge audience, a huge YouTube channel, it's hard for me to justify you doing 506 Bs. You should really look into 506 Cs because you're allowed to then just pitch your deals and scream from the top of the mountains on your platforms that you've got a deal coming up, which is huge.
I'll just wrap this up. The best way is if you're thinking about doing some sort of syndication, probably just talk to somebody about what you're planning on doing and what you should be doing. I don't know if we know any good people who are good to talk to about something like this or do consulting work or anything, but maybe just Google a good person, an SEC attorney or former practicing.
Just Google premier syndication attorney. I'm sure somebody will show up.
Look, I heard a stat today that like 25%, like 1 out of 4 people are syndication attorneys who are unemployed and below the poverty line.
But seriously though, it's you don't want to screw it up because you don't want one mistake or one bad partnership to lead to you just can't do your business anymore. So talk to somebody, figure it out. It's worth it. That's all I got. Top 10, boys? Or do you want to talk about pennies? No, I was making a joke because they are getting rid of the penny, and we discussed about whether it was worth having a mini topic about doing it. But instead of doing a mini topic about them getting rid of the penny, I thought I would do like an homage to the penny because, the penny is kind of worthless. But to me, one of the best things that came out of pennies were kind of spiteful acts. And over the years, every once in a while, you'd see this person who they would use a penny in order to pay for something out of spite that would just inconvenience somebody. And so for everyone's knowledge, the U.S. Coinage Act of 1965 says that coins are legal tenure for all debts, public charges, taxes, and dues. So basically anything that you pay like the public servants or anything for, like they have to accept all coins. And so there's a bunch of stories, and I got 5 quick stories here about people using pennies to pay for things. There was a man in Georgia who he complained of a toxic workplace, and he quit. So his boss dropped off 91,515 pennies in his driveway, greased in motor oil for his final paycheck. So that was one. A man in Texas got a speeding ticket for going 9 over the speed limit. He thought that was a little excessive, went in to fight it. Apparently there was a cash grab for them. So they were just ticketing everybody. So he went and paid 2,000 pennies to pay his speeding ticket. It reportedly took 3 hours to count the coins.
How does that work? Like if I need to get do I go to the bank? Do I just go to the bank and say, hey, bank, I want 2,000 pennies?
But you can go buy it in rolls. And so they come in rolls, and so they can buy in the carts. When I did it, because I did it pay for a speeding ticket, I had to wait. Like I had to get an order in, and the bank had to come in and supply it. And then when I'd get them, I got all of the rolls, and then I broke the rolls open and put them in a bag, and then gave it to them. You have to wait. So you have to wait. You don't get to give it to them and leave. You have to wait till they count it. And so it
this
took,
one. So let me finish with this other one. There was a guy in Virginia. So he was frustrated with the fact that, like, I don't know if anyone's ever had to deal with tax stuff, but they won't give you a direct number to call. You can't actually talk to someone, and then you call, and then they say they're going to call you back, and they don't call him back. And he got so frustrated that he had a $3,000 tax bill that he was trying to figure out. So he decided to do exactly what AJ said. He went out, he got the rolled pennies, and he unrolled them, into 5 wheelbarrows worth. So 300,000 pennies. Or sorry, 30, was that 30,000? I don't know. Pennies. And no, it's 300,000 pennies. So it took him 5 wheelbarrows. So he had to go out and buy 5 wheelbarrows. And fill these pennies up, and he transported them each wheelbarrow at a time and dropped them off. It took them 7 hours to count the pennies, and he had to sit there and watch them count them.
A lot of the states have changed it now. You can't do that. So if you go in today, because like when I did that, I was like 18. If you go in today, they will put on there, like a lot of states have said, we will not accept it. They won't do it anymore.
Fun fact about me. When I was a kid, I wanted to buy my first computer, and I was told save up for it. And I spent 2 years saving pennies to buy my first computer, a Commodore VIC-20, for $110. And after 2 years of saving, I went to the bank, I got penny rolls, and I spent like 2 weeks, hours a day for 2 weeks, rolling pennies. I had pink eye for like a month.
Well, that leads me to my 5th and final story. I thought I'd point out it's not all spiteful stories. There's a heartwarming one where a man, 35 years, he collected pennies because he said he was going to pay off his mortgage with pennies. He rolled them himself. And after 35 years, he had accumulated 62,000 pennies weighing 427 pounds. They were all rolled. He gave the bank the heads up, and he went and he made his final mortgage payment using pennies, 62,000 pennies.
But did he get pink eye from touching the pennies and then
that wasn't part of the story? I don't know. And I think that might just be you saying you got pink eye that way. Seemed like you were a pretty dirty kid. You had other stuff going on.
And I'm surprised on your list of stories is in using it in spite. I mean, people literally leave their waiters and waitresses 2 cents as a tip in a form of protest when they don't like the service.
Now you're gonna have to do a nickel.
You leave them a nickel?
Well, it's not a protest. Basically, the reason they do it is because if you leave nothing, somebody might assume you forgot. But if you leave a penny, nobody assumes that you forgot. They know what it means.
Yeah.
True.
I've never done that before. Has any of you guys done that? Has anybody just left without paying any tip, even if the service was awful?
I don't even think about it.
If it's absolutely the worst service of all times, I'll tip the 15%.
That's what I do. It's exactly.
I don't. Yeah. Though the iPad, turn around the iPad thing, touch. Nope. I don't do that.
Well, that's slightly different, right? That's
I heard someone the other day say, if I'm standing up to pay, I'm not leaving a tip.
Yeah, that's not bad. I'm not being.
Some of them are actual full service, and they just have a paying system where you have to the waitress.
Yeah, that's different. That's different. I'm
talking
like you walk up and they fill your cup up. Yeah.
Yeah. Right. No, I'm with you.
All right, Jay, you got a hypothetical situation for us?
Okay. Hypothetical situation.
You get so happy. I love it whenever I bring it up. You get this little smirk on your face like a giddy little kid. It's my favorite part of the podcast right now, Jay.
I love these. $25 million, but you can only eat sandwiches for the rest of your life. And a sandwich is a food between 2 pieces of bread.
Nope.
No.
25 million sandwiches the rest of your life.
That's $2 million a year in earnings to eat sandwiches. Sure.
You're only going to live 12 years?
No. Wait, what?
25 million.
25 million.
Yeah. So that's $2 million a year in income.
Oh, got it. If you invest it.
Yeah.
And you still have the principal.
Yeah. And it's appreciating.
Yeah. You going to do it?
Yeah. I love bread.
Of all of us, I thought Mauricio would be the one who said no.
Same here.
No. As long as here's a caveat though. If you tell me it has to be a cold sandwich, like a BLT, I don't know, like a whatever, I don't do cold sandwiches, so I'd be out. But if I can do a panini or a melt or a...
What about a calzone? Does a calzone count, Jay?
Yeah, anything. If it's a hot sandwich, you give me a panini.
You say that now, in 5 years, you're like, I would pay $100 million to eat anything. I would give away everything I own to eat anything but a sandwich.
I think 25 is a little low. For 50, I might do it, because at 50 million, it's basically you're doing it for your family, not yourself.
True. Yeah.
But you can have like A5 Wagyu in the sandwich. I mean, it doesn't have to be like, bologna sandwiches. I mean, we can have like high-end steaks and like whatever it is that you love. You can have a ravioli sandwich.
You think you can win our bet?
As high-end as the bread that's on the outsides.
You think you can win our bet only eating sandwiches, Mauricio? Eating bread every meal?
Yes. Oh, if I could win our bet? I mean, we make homemade bread, so ours is pretty healthy.
I do just want to point out how these hypothetical situations of like 100 million and a 225 are like the most privileged conversations like imaginable.
It is.
So
It is.
I just want to make sure that we're all aware of how disgustingly privileged.
It's horrible because I'm getting a lot of these off of Reddit, and I have to change the numbers. It's like 500,000 to eat sandwiches the rest of your life. I'm like, okay, I need.
You gotta
I
factor in
None of these guys would even
know.
think about it.
It's true.
Okay.
All right, that was a good one. You got another one, Jay, or that's I'd save it for next time.
Let's save it for next week.
All right, plugs. AJ, I'll start with you. You got a plug for us?
I do. Go check out the YouTube channel. I think it was the same plug as last week. So got some cool videos. Alex is doing a great job. Go check it out.
Nice. Mauricio, what do you got?
Coachingwithmauricio.com. I'm finally launching officially launching my program on Thursday. So the day this comes out. So if you're interested in attending that, just go to Coaching with Mauricio. I'm going to be fully transparent. I don't know what I'm going to charge for this thing. So I'm just going to keep raising the prices until you guys tell me to stop raising the prices. So if you want to get in, coachingwithmauricio.com.
I just clicked it and it works. So there you go. Up and live. Nice.
Woo!
Jay, what do you got?
Cookies.
Girl Scout cookies.
So good. I'm stuck in my face. Thin Mint cookies. If anybody wants Thin Mints or any Girl Scout cookies, that includes Caramel Delights.
They're so much better than Thin Mints. I don't know why people like love Thin Mints so much. Like they're good, but they got nothing on caramel.
It just occurred to me, I'm going to go on there and I'm going to buy an obscene amount of these and just ship them to you guys next week.
Yeah, show up to her. That's diabolical right there.
Anybody that wants to buy Girl Scout cookies from Kyle's Girls, put a message on YouTube. I'll get in touch with you. Shoot me an email. We'll put a link on the YouTube video. Just reach out to me. I'll put you in touch. And I may even get you a DRE mug.
It'll say Cookie Monster on it. My wife's back from California. She was visiting Mauricio and friends down there, mainly friends. But so I can plug her again. So I'm going to plug my wife. Check her out, Badass Investor at Badass Investor. I just recorded a ton of videos with her like last week. So I'm the person holding the camera. So go check it out. So it makes it worthwhile for me to do that stuff again. Badass Investor, Instagram. I don't know if she has TikTok, probably YouTube, all those things. Check it out. All right. Loved it, guys. Mauricio talking in his wheelhouse. Jay making recession predictions. Good episode. Hopefully we can keep it rolling. We're all back one more week, right? It's 2 weeks when Mauricio leaves it.
Oh, wait a second. Just for the clicks. Donald Trump.
Yeah, we didn't talk about like Trump. What you mentioned twice this episode. That's crazy.
I got it in there, so we can put it in the comments.
I don't think we did mention Doge and Elon Musk though, so we should be fine for that. All right. So I will see you next Thursday.
See ya.
See ya.